Afternoon, everybody. We are waiting for attendees to continue coming in. We're going to give it another minute or so before we get started. Okay, welcome everybody, and thanks for joining us today. We're excited to have over 100 people that have responded to the meeting request, and looking forward to sharing some information about potential upcoming tax law changes with you. During the call, everybody has been set to mute. If you have any questions, we do have a Q&A button that you should see somewhere, I believe at the bottom of your screen. If you want to type any questions that you have during the meeting, we will get to those probably at the end of the meeting. I don't think we'll be interrupting as we go to do that. And of course, if we don't get to your questions or you want one-on-one answers, we're always here to help you with that. So I'm Chad Fenstermacher. I'd like to introduce my associate, Dan Valentino. Dan heads our estate and trust department here at Fenstermacher and Company, and we've worked together to put together this presentation for you. Okay. So the agenda for today, we're going to start with a brief stimulus update. As I think everyone, or many of you may be aware, there is a bill that's currently going through Congress for a vote likely today for a $900 billion stimulus package. We're going to go through just some brief highlights on that. It's not the purpose of the call today, but it is current news, so we wanted to at least talk about that briefly. We're going to touch on tax policy and objectives of taxation, the current political situation. Some of you may have heard there was an election recently, and also a review of the Tax Cuts and Jobs Act, sometimes referred to as the Trump tax cuts. And really the reason for looking at that, we're looking back a little bit at where our tax structure has been over the last several years. But a lot of the changes that we've heard coming out of the Biden campaign have been to roll back some of the changes in the TCJA. So we're going to review that and then talk about those provisions a little bit. And then we're going to go to the Biden tax proposals. I have that in quotations here because we don't have a formal proposal for tax policy out of the Biden campaign. There is not a fact sheet or anything that they've put out. What we've done is collected information that they've had available on campaign websites, also on the Democratic primary debates, certain proposals that were talked about there, and proposals that were talked about on the campaign trail. We've broken those down into individual, estate and trust, and business tax proposals or potential changes. And then we're going to talk about planning opportunities with those potential changes. Okay, first the stimulus update. We're expecting a vote today. Key provisions, there's a lot in here. We're just touching on a handful of things. First, there will be an extension of the supplemental federal unemployment, an additional $300 per week for individuals unemployed during COVID. There will be a second round of stimulus payment checks, $600 to individuals and $1,200 for couples, plus amounts for dependents. Phase outs are similar to what they were before. So if you didn't get it the first time, it's likely you won't get it this round. Although in both the first and the second round, the checks were mailed out based upon the last year, the 2019 tax returns. If your 2020 income falls below those levels, it'll be a refundable amount on that tax return. So if you're entitled to the checks and you haven't gotten them, they're still likely to come. Paycheck Protection Program. We've sent a lot of emails about this, and we've been very involved in the Paycheck Protection Program over the last 8 months or 10 months or so. Interesting with this, round one will reopen for businesses that have not yet applied. So that closed We had all heard that there was still money available in the PPP program. It's going to open back up. So if you have a business and for one reason or not didn't apply, you'll have another opportunity to do that. There will be a round 2 for businesses. We expect this to be much more targeted. It's going to be only for businesses that experienced a 30% decrease in revenue in at least one quarter. So if we're comparing our second quarter of 2020 to our second quarter of 2019, revenues were off at least 30%. The business will likely be eligible to apply again. It seems like the second round calculation is going to be very similar to the first, so we'll have likely the same amount awarded in the second round of that. And the big item, and this isn't final yet, but we believe it's in the bill, is deductibility for expenses paid with the PPP funds. We've talked about this before in the emails. The bill, when it first came out, said that forgiveness would be tax-free. The IRS then said, well, that's fine, forgiveness can be tax-free, but expenses paid with tax-free dollars are not deductible, effectively making the PPP forgiveness taxable. We believe that there will be a fix for that in this bill. And in addition, there's various different funding for transportation, vaccines, schools, rental assistance, and many other things. So let's move on then to the real topic for today, the Biden tax plan. Anytime we're talking about tax law changes, I think it's a good starting point to talk about tax policy and objectives. And what are the goals of taxation? I mean, generally, the first goal and the primary reason that we have taxation is to generate revenue for the government. And if that was the only purpose for taxation in our tax code, it would probably be a much simpler tax code than what we have today. But Congress and the government uses tax policy to accomplish objectives other than just pure revenue generation. It's used for economic objectives. So if we have economic downturns and we want to stimulate the economy, that can be done by putting more money into the economy through economic reasons or through taxation reasons or tools, giving businesses the ability to write off equipment and other things to incentivize them to invest in new equipment and stimulate the economy. And it can also be used to slow economic growth and inflation if growth is out of control, which I guess we haven't seen that for a little while. Additionally, another goal with taxation is social objectives. You know, we all know that we can deduct the interest on our houses. The tax code has been used to encourage homeownership. We have tax credits to encourage education. And it also can be used as a tool for income redistribution through refundable credits and graduated tax rates. Okay.
So our current political situation, we have Biden as the president-elect in the White House. Currently, the Democrats control the House, and they retain control after the elections. The Senate is still a toss-up. The 48 to 50 Democrats to Republicans. We have 2 seats in Georgia that are currently being run, and we will know more about that in the beginning of January. However, this is a big point in the fact that should the Democrats win both seats, they will have a majority, with the tiebreaker going to Harris. And if they split, the Republicans will maintain the majority with 51 to 49. So with the narrow margins on both Senate and the House, bipartisan will be needed to make progress on bills. We're going to go over a lot of things that are expiring regardless of changes. We will need both the Democrats and the Republicans to work together to make sure that legislation does get passed. And for that also includes the tax bills. They got to go through Congress to be made. And currently the Republicans control the Senate. So if they retain control, we do know certain stances regarding decreases in taxes, or increases in taxes that aren't that popular. And then we also have the expiring Tax Jobs Acts. Will likely not have the votes extended after 2025. So a lot of the current makeup of the Senate and the House will go to what we see in 2025 when those cuts expire. Oh. So we're going to review the Tax Cuts and Jobs Act. This was passed in 2017 and made effective 1/1/2018. And one of the big things, at least for the individual changes, which I will hit on first, was the top tax bracket. Now, all of the brackets and the levels were reduced, but the top tax bracket went from 39.6 down to 37. One of the goals was to simplify the tax reporting, and through that, the standard deduction was doubled. This also saw a cap or removal of certain deductions on the Schedule A. You had state and local income taxes and real estate taxes were capped at $10,000, and miscellaneous itemized deductions were eliminated outright. For a lot of clients, the doubling of the standard deduction really didn't come into effect because we had significant Schedule A deductions already. And then also the cap on the 10,000 wasn't really that impactful because of certain limitations due to AMT and PEAS limitations. So, however, what we did see was about 28.5 million taxpayers, a lot of everyone else saw a simplified method of filing by using standard deduction instead of the Schedule A. And this reduced a lot of common errors that are found on the Schedule A with transposition of numbers or picking up just incorrect information.
And Dan, that's an interesting point. There were a lot of people that were very upset with the capping of the state and local taxes at $10,000, particularly in high tax rate states like New York and California. That, along with the other items that were taken away, it's interesting that state and local taxes, miscellaneous itemized deductions, and personal exemptions are all, in effect, preference items for the alternative minimum tax. So if we look back to our 2017 tax returns and we see a substantial amount of alternative minimum tax, even where we may have had a deduction for these items, we may not have been getting a tax benefit for them.
Another welcome sight on the Tax Jobs Act was the elimination of the individual mandate. It is still part of the code, but the penalty was reduced down to 0. And this was the penalty for being able to afford health insurance, but not actually having health insurance. And then finally, what we're going to talk about is the lifetime exemption for estate and gift tax was doubled from 5 million to 10 million. And also, well, it was indexed for inflation, but it was doubled. Currently, the lifetime exemption is 11.58 million per person.
Okay, so we also saw a lot of business changes with the Tax Cuts and Jobs Act. You'll recall that when this change was coming through, there was a lot of discussion about corporate tax rates and an effort to make United States corporations more competitive in the global economy. In 2017, the United States had the third highest marginal corporate tax rate in the world at 38.9%. Now that includes the top federal tax rate at 35%, plus there's a average state tax rate, I think, that they included in there to get to 38.9%. The worldwide average was at 22.5%. So it put US corporations at a significant disadvantage, and multinational corporations, when given the opportunity to operate in the United States or to operate somewhere else, it made operating outside of the United States advantageous from a tax perspective. So with the Tax Cuts and Jobs Act, the federal corporate tax rate was reduced from 35% to 21%. And after passing that together with the state, the tax rate included in that, we ended up with a marginal rate of about 25.8%. So getting a lot closer to that worldwide average of 22.5%. So there was a substantial tax cut for businesses that are taxed under the corporate tax structure. However, many businesses and the majority of our clients are not taxed under a corporate rate structure. They're taxed as pass-through entities. And what that means is that a partnership, an S corporation, or even a sole proprietorship, the income that's calculated for that business doesn't get taxed at the business level, but it gets reported on the individual taxpayer's tax return. So they're paying tax at the individual tax rates on that income. In an effort to try to put these pass-through type entities on the same playing field, or to give them the same tax benefit with this change, they created what's called a qualified business income deduction. And this allows qualified businesses, and generally qualified businesses are non-professional services businesses, non-specified services is the term that's used, but operating businesses where the owners are active in the business. The 20% deduction of the qualified business income is allowed, so effectively businesses are paying tax only on 80% of the income that they're generating from the business. Very substantial tax break for all of these pass-through entities, or at least the ones that qualify under the qualified business income rules. The Tax Cuts and Jobs Act also eliminated or repealed the alternative minimum tax on corporations, simplifying tax calculations to some extent. And Section 179, our business clients are familiar with that. Section 179 is a code section that allows us to take a deduction for business equipment that's purchased during the year. So if we go out and we buy trucks or we buy office equipment, we can elect to take the full amount of that purchase price as a deduction in the year of purchase instead of depreciating it out over a period of time. It applies to equipment, generally not to real estate, but it really provides businesses with an incentive to invest money in the business because they can get the current tax deduction for that. That deduction was increased from $500,000 to $2 million, and the income limitations were increased there as well. So for the majority of our businesses, that allows us to effectively write off everything that we purchase in the year that we purchase it, which is a great option to have, especially for tax planning at the end of the year. There's also a new tax that was created, really, the GILTI tax, the Global Intangible Low Taxed Income tax. And the idea behind this, without getting into too much detail, is that corporations that earned income, multinational corporations that may have been US-based, that earned income overseas, in order to bring that income back and reinvest that in the United States, they had to pay tax at the US corporate tax rates to bring that money back. This new tax was created to tax the income as it was earned on certain types of income, but then to allow these corporations to bring the income back to the United States. So really it was an incentive to try to get businesses to invest back in the United States.
So there are a number of provisions from the Tax Jobs Cut Act that are sunsetting. Kind of wanted to go through some of them, mainly because these are going to tie into the proposed plans that Biden put out there, as well as some of the planning opportunities towards the end of the show. So the income tax brackets were increased, as I kind of went over, and unless anything changes as of 12/31/25, we're going to go back to what they were before. So you're going to see the broadened tax brackets and also the 39.6% rate come back in. We'll see the standard deduction drop from $24,000 to $12,700, what it was before the Tax Jobs Act. And we'll also see the personal exemption come back in to $4,050. And the state and local taxes that were capped, that cap will be released. Miscellaneous itemized deductions are also going to be back in. Those are the 2% deductions. Elimination of home equity loan interest deduction is going to be reintroduced. And then the estate lifetime exemption exclusion, That's going to be decreased back down to what it was before the Tax Jobs Act. We have from 5 million to 10 million was the increase. The decrease, when it goes back down, will be also indexed for inflation. So it won't be 5 million, it'll be that plus inflation.
So, and I think it's important when we're talking about these sunsetting provisions from the Tax Cuts and Jobs Act. When we started the call, we focused on some of the changes that have been going on in Congress, certainly with the change in the control of the White House, potential change in control of the Senate. So with those changes, if the Senate remains in Republican hands and we're not able, or the Democrats are not able to get some of their proposed changes through, then at the very least, we're up against the sunset of many of the tax cuts under the Tax Cuts and Jobs Act. So the likelihood then is that we're not able to, if these are not able to be passed and we don't have bipartisan support to extend these end anyway. On the business side, we have bonus depreciation, which allows us, it's very similar to the 179 deduction that allows us to write off equipment when it's originally purchased. That had been increased from 50 to 100%. That'll sunset in January 2024, earlier than some of the other changes. Qualified business income deduction sunsets again at the end of 2025. The deduction for foreign derived intangible income, again, tied with the GILTI tax, that deduction is going to sunset, and some other changes with the international tax there.
So one thing I wanted to show is we were talking about the effects of the Tax Jobs Act, the provisions that were included. The majority of it was a tax reduction, or the plan was to reduce taxes, make the U.S. more competitive, especially globally. And that was seen at more of the corporation type rate. And well, how did it turn out? How did it happen? So what we're seeing is information from the IRS. They collect it every year on a fiscal year and report everything. Now, the numbers you see are in thousands. So from 2017, that was before the Tax Jobs Act was enacted, to 2019. Now we do see 18 in the middle. And what we're seeing, the business income, we're seeing that decrease. So from 293 billion, it decreased to 225 billion. The individual trust and estate income section, that actually increased. We saw 1.48 trillion in revenues, net revenues collected in 2017. And in 2019, we're seeing 1.58 trillion collected. So it is positive to see revenues increase even during times of tax deductions. The employment taxes, those are more of our payroll taxes. They had a slight increase. The estate and gift, this is that lifetime exemption section that I was telling you about, decreased from 22 billion down to 16 billion. That was expected. The totals, we went from 2.97 trillion in 2017 up to 3.11 trillion. So that is positive to see. Overall, we're still collecting more net revenue.
So it's interesting with decreases in tax rates, we saw an overall increase in tax revenues. Now it's not a huge increase. We had less than 1% increase in total revenues from 17 to 18, and a little over 3% increase from 18 to 2019. Somewhere close to in line with the growth in gross domestic product. Okay, so what are the Biden plan goals? What do they wish to accomplish? And again, this isn't taken from a tax policy statement or anything out of the Biden campaign. This has been pieced together based upon what they've said on the trail and what their website has said. Generally, they want to see a reduction in the effective tax rate for middle-class families, and that should go hand in hand with an increase in the effective tax rate for wealthier earners. And repeatedly, we heard candidate Biden say that families under 400,000 would not have a tax increase under his tax law changes. So it's interesting to see that number is at 400,000. Several years ago, we always heard the 250,000 being that break point on who should get a tax increase and who should get a decrease. One of the things that I think we've seen over time, and as we see the control go from the Republicans to the Democrats and back and forth again, is we've seen a continued theme where the Republicans seem to want to decrease taxes across the board. And those taxes do go down across the board. In terms of dollar cuts, the larger cuts go to the higher taxpayers, so the higher income. But there are tax cuts across the board. And then we see the Democrats come back in and they want to increase tax on the rich, but decrease on the low. So if you look at it, if we start here, the Republicans do this, the Democrats do this, Republicans do this, and the Democrats do this. So what we seem to have is I think there's a general agreement that we should have a graduated tax rate system. The question becomes, what is the appropriate amount? Is it this, or is it this, or is it this? What should that level of graduated tax rates be? So with the Democrats coming back in, they're now looking to decrease the effective tax rate on middle and lower class earners, increase it on those wealthier earners. They're also looking through the tax code to penalize corporations for outsourcing jobs on consumer products. And here's another example of, it's not a revenue raising objective of the tax policy here. It's actually to satisfy another objective of keeping those jobs in the United States.
Before we go on, someone was inquiring if the 400,000 earnings threshold is based off of top line earnings or adjusted gross income. And I mean, right now, because nothing's been formally proposed, the Congressional Budget Office hasn't received anything. We're just going off of wording as it's presented, and it's really loosely defined. So right now, we're calling it earnings, but we're not 100% sure if that's going to be AGI, taxable income, or just like wages.
Yeah, and Dan's right. A lot of this really isn't defined. Even the 400,000 number, we're assuming that they mean families and not individuals. So a lot of the information here is really not very clear. Somebody also asked if they could have a copy of these slides. We'll be happy to send those out after the call. So the next item, taxing individuals making more than $1 million to pay the same rate on income as they do on their wages. And I think we've all heard the Warren Buffett secretary's tax rate is higher than Warren Buffett's, and how that's wrong, and we need to fix that. And there's certainly some truth to that. I think Warren Buffett should probably pay more taxes than his secretary, and I guess I'm guessing that he probably pays a lot more than she does. However, what they're talking about here is the capital gains rate. We have a lower tax rate that's imposed on capital gains, long-term capital gains for investments that we've held more than a year. And that's the only threshold, is more than a year. So it could be a year and a day, it could be 20 years, 30 years, any of those periods, it's considered long-term. That same capital gains rate is also allowed on qualified dividends. That's income that we receive as dividends from corporations that have already paid corporate income tax rates on that income. So it's to allow effectively that lower rate because that income has already been taxed one time. So while changing this and making the rich pay the same as everyone else, it sounds good in a debate or a stump speech, but there's a couple of issues with it. One is that a lot of people have maybe 1 year of a very large gain. Maybe the family farm was sold. Maybe the family business that they've been building for 20 years is sold, and it sold at a $2 or $3 million gain. Well, that has taken a long time to build. There's been a lot of investment in that. And should that be taxed at a 40% rate for federal taxes, or should that get the benefit of the lower capital gains rate? So it'll be interesting to see what happens here. If you're a taxpayer that consistently has income in excess of $1 million, I think it's something I'd want to pay attention to, and we'll talk about some planning ideas with that as we get further into the call. The proposals are estimated to increase tax revenues potentially between 2.4 and 3.3 trillion dollars over the next 10 years. And if we look at that, that's approximately the total revenues that are being generated currently. So it would roughly double the federal tax revenues over a 10-year period. Spending priorities, there's all of this, obviously all of these tax increases aren't going to pay down the debt, but there are other priorities for spending, including infrastructure, healthcare, developing alternative energy sources, and building up the US manufacturing sector.
So some of the changes that we're seeing proposed, and a number of these are building upon what has already existed in the Tax Jobs Act. So the first one is the child tax credit. This was introduced, or this was increased to $2,000 from the Tax Jobs Act to help offset a lot of the reductions that were coming through with the personal exemptions and loss of other deductions. So the child tax credit was increased to $2,000 between 2018 and 2025. And what Biden is looking to do is further increase that to $3,000 for children between 16 and 17, and $3,600 for children under 6. And in addition, he wants to make that fully refundable. And kind of what that boils down to is someone with no taxable income due to either the wages or the standard deduction being what it is, they can still receive a refund based upon the child tax credit. We're also looking at the expansion of refundable health premium tax credits. And really what President-elect Biden is looking to do is make sure that healthcare is more affordable to people in certain areas. So he's looking to make sure that tax-paying families will not pay more than 8.5% of their income for health insurance. Increases to the child and dependent care tax credits to $8,000 for one child and $16,000 for 2 or more children. And this does get phased out. So it is currently in place at $3,600, $6,000, but it's looking to more than double in some areas to $8,000, $16,000 under Biden's plan. The reintroduction of the first-time home buyer credit for up to $15,000. There wasn't a lot that was written about this. However, we have seen this credit a number of years ago. So it is nice to see this one come back. And then restoring of tax credits for residential energy efficient improvements. I mean, this was kind of the $500 lifetime cap. We're not sure if that's going to be increased, but it has been reintroduced it's planning to be reintroduced under Biden's plan. Oh. There we go.
Okay, so those are the tax benefits, and of course we need to find a way to pay for those. We have tax increases to do that. Reinstating the 39.6% bracket as the top bracket, up from 37%, when income exceeds $400,000. Now, it's not clear if there will be that bracket now starting at $400,000, because previously the top bracket was started at about $500,000. And again, this all depends. We have different brackets for individuals filing as individuals or jointly, and we don't have a lot of details on that. But 400,000 seems to be a magic number there. There's a change to cap the tax savings on itemized deductions at 28%. And this seems to be a recurring theme in some of the changes that we're seeing and what we've heard over the last several years. And the argument is that in the interest of fairness, an individual who is in the top tax bracket, currently at 37%, that has itemized deductions for mortgage interest, charitable contributions, medical expenses, and whatnot, it's not fair that they get a 37% benefit for taking those deductions when somebody in the the 10% bracket only gets a 10% benefit. So the idea would be to cap the savings on those itemized deductions at 28%. And it's a substantial change in the way we look at it. You know, currently we look and we say, okay, at the end of the year, if we make charitable contributions, that reduces our taxable income. Well, if this happens, then yeah, it may reduce your taxable income, but you're still paying tax on some of that income that was used to create those contributions. Also, a reintroduction of the P's limitation, and this was a phase out of your itemized deductions once your income reached a certain point. So high income earners would lose the benefit of their itemized deductions as their income went up. That was repealed under the Tax Cuts and Jobs Act. It certainly simplified the tax planning and tax projections, and that's something that would likely come back under a Biden administration. Long-term capital gains and qualified dividends rate increases to 39.6% for those earning more than $1 million. I think I covered that pretty well before. And lastly, well, lastly on this slide anyway, and this is a big one. It's imposing a 12.4 Social Security payroll tax for wages above $400,000. This has been referred to as the donut hole. So we have Social Security that gets maxed out currently when the wages hit $137,700. Over and above that, we don't have to pay on the Social Security piece. We just pay on the Medicare piece. So 12.4% is paid for Social Security. That's split between the taxpayer and the employee and employer. And there's another 2.9% that's paid by, again, the employee and the employer that has no limit. So the idea here is to stop collecting it at 137,000, but then at 400,000 begin collecting it again. It raises a lot of questions because the idea behind the Social Security system has always been that you pay into the system, and based upon how much you pay into the system, that determines how much you get back out of the system. Now, the return, if you will, on your investment for higher income earners that are maxing out that 137,000 is pretty low compared to what the return is for lower income earners, but everybody gets something for what they put into the system. So it's not clear whether high income earners or very high income earners, we'll call them, that are paying now this additional 12.4% on all earned income over $400,000, if their Social Security benefit continues to go up, or if that's just a contribution into the system without any return of benefit. But it's a substantial amount, and it changes the tax scheme somewhat. So this is a comparison, and we're going to pick on California because they have the highest tax rate in the country. But looking at the highest marginal tax rate for a self-employed individual. And we're picking a self-employed individual because they paid both sides, both the employer and the employee side of the tax. So we're making this look as bad as we can make it, but that's kind of the point of it. So under current law, an individual self-employed person in the highest marginal rates pays Medicare tax at 2.9%. And now we're talking marginal rate. So this means each additional dollar that they earn. And that high income taxpayer is already past 137,000. So they're not paying that tax anymore on each incremental dollar they earn. But they are paying the 2.9% Medicare tax. They're paying a 0.9 additional Medicare tax that came as part of the Obama tax law changes that we had several years ago. They're currently paying a 37% top marginal federal rate at 37%. And in California, again, picking on them because they're the highest at 12.4%. So the unlucky self-employed taxpayer today in California is paying just over half of their income out in taxes. Under the Biden proposal, if we bring back this donut hole, and this self-employed individual is making more than $600,000 a year, we're effectively just adding in this 12.4%. We still have the Medicare, additional Medicare. Our federal tax rate goes from 37 to 39.6. We're assuming no changes in California, and we get to a total marginal tax rate, again, that incremental tax on each additional dollar of over 68%. Now, it's probably a little bit lower than that because we are allowed a deduction for a portion of the Social Security and Medicare tax that we pay as a self-employed person. But I think we can count on about 65% marginal tax rate in that situation. Now, we've heard a lot during the campaigns about the rich paying their fair share. And when I said at the beginning, everyone agrees that there's the marginal tax rate, that an incremental tax rate the rich should pay more is fair, or most people at least agree that. The question is, how steep is the curve with that? And I think the question is here, have we gone beyond at 68% what the fair amount is, and where is that proper amount? Okay, retirement savings. Now, again, I caution everybody that there's no formal proposals on this. It's based on statements that have been made and maybe some things on the website, and then a lot of interpretation in what those mean by tax pundits. So Biden has proposed to equalize the tax savings on retirement savings to benefit lower income taxpayers. And this follows the same discussion that we had about itemized deductions, that it's not fair that somebody in the top bracket saves at 37 or 39.6%, whereas somebody in a lower bracket saves at a much lower amount. They're applying the same thinking to retirement savings. And this is an area where lower income taxpayers typically have not saved enough, if you will, for retirement. There's been a lot of effort expended to try to get those individuals to save more for retirement and hopefully be less dependent on Social Security when they do retire. So there's no specific details here, but it has been interpreted to mean using a credit system. So instead of getting, when you put money into the 401k, it comes off of your income and it reduces your income at whatever your marginal tax rate is, that would be replaced with a tax credit. The Urban Brookings Institute has said that 26% would be tax neutral. We haven't heard any percentage come out of the campaign, so that's really just a guess. But that would level the playing field and everybody would get the same benefit from that. The credit may be deposited as a matching contribution into the retirement account. And it certainly benefits low-income savers because they get a better benefit for their savings. Now, the problem becomes, and it's really fundamental to the idea behind retirement savings and to tax planning as a whole. I mean, ideally, we want to be able to get a deduction today at our high marginal tax rate while we're earning at a high level. Take that deduction today, save the money in the retirement account. It grows over time. And then when the money comes back out, when we're in retirement, our income is lower, our tax rate is lower. So we're getting the benefit of this tax deferral, and we're getting a bigger savings than we're having to pay tax on the other end when it comes out. And that's a great planning tool for retirement. While replacing that and using a credit system instead, then we really need to look and say, okay, well, if we're at a 26% credit today, what tax rate do we expect to be in retirement? And if we expect to be in a higher tax rate potentially in retirement, then we're getting a savings today at a lower rate after all of the growth that we're going to have to pay in retirement may not be such a good deal anymore for the higher income individuals, and also for business owners, the individuals that are putting these plans into place. So potentially we could see some of these changes as a disincentive to business owners to provide these types of benefits for their employees. It may also, and again, I don't want anyone to go running out and start making changes right away. This is really highly speculative in terms of what these changes would be or when they may come into play. But making Roth contributions, if they're still available, may be a better way to go. And with a Roth contribution, you don't have a tax deduction at all when the money goes into the Roth account, but it comes out tax-free with all of the growth when you pull the money out in retirement. Okay. There's also been discussion of an automatic 401k for almost all workers. So that would be a mandated withholding from an employee account, and employers could be mandated to participate in this. Anytime you have something that's applying to all workers, including workers in small businesses, the burden on very small employers that may have 1 or 2 employees to have to establish these plans and comply with these plans can become cumbersome. But these are some of the proposals related to the retirement plans. I see there's a question regarding step up on inherited property, and we do have that, and we'll get to that
right now.
So
so Biden, President-elect Biden has hit on individuals, on businesses, and Chad will get to that in a little bit. Estate and gift changes are not as numerous, but they are very impactful. So as I mentioned earlier, should Congress do nothing, which sometimes is a great thing, but should Congress do nothing, the lifetime exemption will go back down to what it was before, around 5 million plus inflation. But Biden is looking to reduce that even further to 3.5 million per taxpayer. So that's a significant reduction. And he's also looking to increase the top tax rate to 45%. Currently, the top tax rate for estate taxes is 40%. And this is the big one: the elimination of the step up of assets when passed through an estate to the heirs. So a lot of planning goes into effect right now with regards to how to best get the assets from your estate and into someone else's, into the beneficiaries. And when the majority of our assets are under the lifetime exemption threshold, the 11.58 million, we'll generally just say, we'll keep it in our names, and then it'll pass out. The assets basis will get a nice step up, and then the inherited beneficiaries, they don't have to worry about paying a tax on that, or at least the estate tax on that, and a lot of times the income tax, capital gains rates, as Chad was mentioning earlier. But with the elimination of the step up of assets, now it comes into, okay, the passing on of the assets to the heirs will not get rid of the appreciation. Now, towards the end of this, we'll go into some planning opportunities that actually deal with getting assets out of your estate without an estate tax hit. And that type of plan now becomes all the more reason, or all the more important, that we have to look at this.
Okay, skip that, right? So business changes, and what do we expect to see here? There's been discussion of raising the corporate tax rate. You'll remember that we were at a 35% tax rate before the Tax Cuts and Jobs Act. That was reduced to 21%. Biden has discussed increasing that back to 28%, which is approximately half, it's right at half of what that prior decrease was. The next item, a flat 15% tax on book income or financial statement income on corporations of $1 million or higher. And we hear over and over again how all of these loopholes allow rich corporations to pay no taxes, and corporations that have income to pay no taxes. And where that comes from is that there's multiple different ways to account for income. We have generally accepted accounting principles, which are used to report financial statement income for businesses. We also have an internal revenue code that tells us what items can be deducted, when they can be deducted, and when items are taken into income for income tax purposes. And those two may be very different. And good planning by these corporations may allow acceleration of deductions. So corporations that have financial statement income under the GAAP method do not have taxable income under the Internal Revenue Code. So what this proposal has been is to impose a flat 15% tax on the book income. So looking at their financial statement income and effectively creating a minimum tax on these larger corporations based upon another set of books. This doesn't have a whole lot of support, I think, on either side of the aisle, and it's probably unlikely, but it's one of the items that's been thrown out there as a potential change. The GILTI tax, that's the foreign income tax, increasing that from 10.5% to 21%, and the phase out of the QBI deduction. And this is I think more impactful for the majority of our clients. That pass-through income deduction for businesses, where they can deduct 20% of their income, that will likely be phased out under a Biden administration for individuals earning more than $400,000. So that's pretty substantial change. Again, there's a lot of things that have to happen before we see those changes, but potentially we could see that as a change. Okay, credits and penalties for moving production onshore and offshore. Again, our tax policy slide, it's not just about revenue generation, it's about other objectives of the government. Biden's proposing to use a carrot and a stick approach for corporations to not move production overseas, and if it's already overseas, to bring it back and provide surtaxes and credits to achieve those policy goals. And also to deny deductions for moving jobs offshore. One of the items in the Tax Cuts and Jobs Act that is favorable in the Biden administration is the Qualified Opportunity Zone program. This is a program that allows individuals to defer recognition of tax on capital gain income by investing their gains into distressed communities. And they can do that through Qualified Opportunity Zone funds. So certain areas, blighted communities, are identified as eligible for this, and investments in those communities can allow a deferral and in some cases even a decrease in the capital gains tax that's paid. And also a shifting of tax incentives from the fossil fuel energy industry to alternative energy initiatives. We don't have a whole lot of detail on what those incentives are that would be taken away from fossil fuel and given to the alternative energy, but it is an item that's been discussed. Okay, so planning. What do we do with all of this information? And first of all, as I've said several times, it's really speculative at this point. We wanted to get this out to you early before the administration is sworn in and before these changes happen, but it really still is early on, and we don't know what's going to come. The two tenets in tax planning that we've talked about is we want to reduce our overall tax liability. That's the number one goal. What can we do to reduce our tax liability? And when we can't reduce our tax liability, well, let's defer it. Let's push back paying those taxes as long as we can, so we have that money, we can invest that money and use that money until we have to pay those taxes. The issue we have now is we have likely an increase in tax rates going forward. The Biden proposals show us that we'll likely, for higher income earners, have increased taxes going forward. So that second tenet of deferring paying taxes, well, if we defer taxes out 5 years, then potentially we're after the retiring of the Tax Cuts and Jobs Act provisions and potentially additional increases that may come in under Democratic control. So the deferral isn't quite as a great option as we look now. Our long-term outlook, this is really, again, still speculative at this point. I think we're going to have increasing tax rates. I've been saying for some time now that the tax rate structure that we have now is probably about as good as we're going to get, particularly for businesses with the qualified business income deduction. If we look at the spending that's occurring, the Congress is voting on a bill today for a $900 billion, almost another $1 trillion spending package. We already spent $2 trillion earlier this year. You put the two of those together, and I think that's the total revenues for an entire year that we've spent just in the stimulus packages. Not commenting on whether that was needed or not needed, just the fact is it's a ton of spending, it's a ton of additional debt. At some point, we're going to need to see that increased debt starting to reverse. And one of the mechanisms for that is increased tax rate. It's either increased tax rate or decreased spending. And it seems like over the last several administrations, whoever's in there, nobody's been successful in decreasing the spending side. So it looks like it more and more likely that it's going to have to come from the revenue side. Timing, again, it's still a toss-up to some extent. There's a lot riding on the Georgia Senate runoff. If the Republicans retain control of the Senate, then it certainly defers out and slows down some of these provisions. I think in either case, it's not likely that we'll get retroactive tax increases to January 1, 2021. I think it's more likely that we would see those changes beginning in 2022 if the Democrats take control and they're able to get those through. So it's still quite a bit of a toss-up. So watch that Georgia Senate race. But what we have some level of assurances that those Tax Cuts and Jobs Act provisions that we spoke about, they're scheduled to expire. So unless we get broad bipartisan support to extend those, we're likely to see many of those expire or at least be reduced in some way.
So, I mean, we were kind of going over a lot of the changes, a lot of the review in the Tax Jobs Act. So what are we looking for on planning opportunities going forward, especially in the next few months, beginning of 2021? Well, with the increase in tax rates, we need to make sure we have proper revenue recognition. So we don't want to delay revenue or delay capital gains to a higher tax rate. So some of the things that we're looking at right now are Roth conversions. If they're on the table, if they're in the plan, it's better now than going forward if we do it under a higher tax rate. So we're looking at accelerating Roth conversions while the rates are still low, and recognizing capital gains. So there's a lot of unrealized appreciation. The markets have been doing very well over the last number of years, and the question is, what do we do with this appreciated stock? There's been a lot of conversations with regards to charitable intent. By donating stock to charity, you don't have to recognize the capital gain. Chad mentioned earlier, qualified opportunity zones or qualified opportunity funds are ways to delay the recognition of capital gains, and even in some instances, reduce the amount of capital gains that you'll actually pay tax on. However, you don't want to just kind of look at it from the individual aspect. The estate plan, someone mentioned earlier about the lack of step up, should that be implemented, but we're also looking at a reduction in the lifetime exemption. So if Congress doesn't do anything by 2025, it's going to go back down to 5 million plus inflation. But if Biden's plan does go through and he gets what he wants, it's going to go down to 3.5 million. So we want to make sure that we have the estate plan in place now. And some of the things that we look at when we talk about an estate plan is, well, do you have a charitable intent, or what is your charitable intent? Are you looking to create a legacy for your beneficiaries to live off of going forward? Or do you just kind of want to get assets out of your estate but still maintain control of it? There's a lot of different ways that we can do estate plan, but they do entail what your income tax plan is, what your financial plan is. So right now, since we're faced with a lot of changes going on, and some unknowns due to the makeup of the current political structure, we want to make sure we look at everything. So it is a really good time right now to revisit your estate plan, and hit these areas. If it's not something you've thought about before, definitely start thinking about, do you want to create something that lives on for charitable reasons, or do we really just want to address that lack of step up on appreciated assets? We also want to take into consideration what your estate plan will look like at both the state level and the federal level. So there's many assets that go into this. And so when we start talking about your income tax planning, we do really also want to know what your estate plan is as well.
Dan, we had a question from a participant. What is a Roth conversion?
So currently we have IRAs that are categorized into two different areas. So we have the traditional IRAs, which act a lot like most other tax deferred plans. And what happens is when you put money into a traditional IRA, generally you will get a current year deduction, or you'll prevent it from being taxed currently. Roth IRAs are taxable IRAs where you pay tax putting into it, create basis, and then at the end of or when you go to retire, that money comes out tax free. So accelerating
with all of the growth.
Sorry.
Along with all of the growth.
Right? Along with the growth. So a Roth conversion is taking your traditional IRA and converting it to a Roth IRA. And it is as simple as that, but there's a lot of planning that goes into effect on behind the scenes as to how much should you be converting. Because what happens is when you take money from your traditional IRA, it's going to be taxable currently, and then you put it into your Roth IRA. So we're looking at big spikes of income currently, so that when you retire, that money comes out tax-free. It also grows tax-free. So when we talk about accelerating Roth conversions, we're talking about trying to get those Roth conversions in years where that top bracket is 37%, or where the middle brackets are a little bigger with lower rates than as if in a couple of years, either the current structure expires or Biden puts in a new graduated rate system where when you do that conversion, it's going to be taxed at a higher rate. So that's kind of what we're talking about.
Good. Tax planning opportunities for businesses. Again, it all comes back to the timing on some of these changes. Generally, we want to decrease the overall tax liability, and secondly, we want to defer it. The question is, does deferring it defer it into a higher tax rate, and is that the right decision to make? So it turns things on its head a little bit. Where we generally try to defer revenue recognition, at some point it may make sense to be accelerating revenue recognition, particularly if we think we're going to lose the qualified business income deduction or get a jump in the corporate rates. So deferring revenue recognition, it may not be the best way to go now. Delay capital expenditures to offset income taxed at higher rates. That may be one consideration. Let's wait to purchase equipment. Let's purchase it when we've got a higher tax rate structure so we get a better deduction then. And do we elect out of accelerating our depreciation? Do we decide to take depreciation over time so that we get those deductions again against that potentially higher tax rate structure that we have in the future? Retirement plan considerations. We have some ideas on where they may go with changes there, but what that means for businesses right now, we don't know. So that's pretty much an open question and something that we will consider as we go forward. And it's always a good time to revisit your business model and succession plan and see where, how these changes may impact that. Okay, so we're just over an hour, and we've had the Q&A session did work out all right through the pop-ups as we went. If anyone has any additional questions, we'd be happy to take those now. If not, this will conclude our call.
So someone is asking what the definition of middle-class families are between X or less than 400,000. That I'm not too certain, Chad.
Okay. That didn't pop up on my question. So middle-class family, and I think that generally in the current environment, I think we're defining that as individuals with income under $400,000. Lots of different definitions of that, but in the context of the slides here, it's lower than that $400,000 threshold.
In addition, while everyone's still here, we will be sending out an evaluation form looking for feedback on today's topic and also ideas on future topics. And we will also try and make these slides downloadable for everyone.
Okay. Well, thanks, everybody. It was a pleasure. We enjoyed doing this. If anyone has any other topics they'd like to hear in the future, I think this is a great way for us to, in the COVID world, be able to reach out and get in touch with our clients. I hope everybody has a wonderful holiday, and we'll look forward to seeing you in the new year. Thank you.
Thank you.